Just a quick video today talking about to move your stop or not to move your stop. That is the question. Let me just step through a couple of examples here. As you see, we get an automatic TS3 setup here. And again, one click, I put the analysis on the chart. With the trend, the STF here is red, meaning the trend is short or to the downside. So I'm clear to take this trade. Risk of $270. I can short 2 contracts based on this account size with a stop at 10,415. And the 100% initial risk is what we want to look at in this particular video. 10,361. That basically tells us when we're up, 270 bucks. It's equidistant from our entry to stop, and then entry to this 100% initial risk line here. And the rule is, if price reaches this 100% initial risk, if you get entered in the trade and it reaches this 100% initial risk, you can move your stop from the initial stop at 10,415 to your entry. And the other option is you can just leave your stop where it is, and if price hits here, you just continue to leave your stop there and just let the trade play out, and either it comes back and stops you out. So let's just see what happened in this trade. So we're entered into the trade. Okay, so we've hit this 100% initial risk, and we then let's say decide to move our stop to the entry, and let's just see where this goes from here. Oh, let me put the analysis back on here. Okay, so you see in this case, we hit the 100% initial risk. If we moved our stop to the entry, we're stopped at our break even there. And that saved us from taking the $270 loss on that trade as it came up, and would have taken us out at 10,415 had we not moved the stop up. So, good. All's well there. But let's just take a look now later in the day at another setup. Okay, now later in the day, let me just step this forward. We get another setup, an automatic TS4 setup. Again, this is the trend is gone. It was long, it's gone neutral here, but we're still clear to take a long signal or a short signal if one setup. In this case, it's a long signal. And let me just put the analysis on this. And it tells us we can take 4 contracts at 10,390, risking $400 with a stop at 370 here. Our 100% initial risk now is 410. So let's step forward on this. You can see we get entered there. Let's just see how this one works out now. Prices come up. We've hit that 100% initial risk at 10,410. So if we're going to move our stop up from 370 here to our entry at 390, let's see what happens. Okay, so it does touch 390 to the tick there, which means we'd end up with a break-even trade here. But let's continue forward and see what happened with this trade. Okay, right here, high of 471, we hit our target, which was a 4-to-1 risk reward with a profit of $1,620 that now we missed out on because we had moved our stop from entry to break even once we hit the 100% initial risk. So you can see how these would work for you and against you. The first trade, moving the stop up, worked in your favor and protected you from losing the $270. On the other hand, this trade, it went against you in that you had a break-even trade, which, you know, it's not going to hurt you as far as taking a loss, but you then lose out on a potential $1,600 in profit by doing so. So is there a right way or a wrong way? No, it really depends on you know, how you want to manage the trades. But whatever you do, you know, be consistent, and I think in the long run it probably evens out either way. You save yourself some losses, and then at the same time you may lose out on some of the winners by doing so. But I hope that's helpful. Maybe it doesn't help you make a decision, but the point is you want to be able to manage your trades consistently, and that's the best way. Once you start second guessing yourself, that's typically when you tend to get in trouble when it comes to trading. So set your rules and follow your rules. Plan your trade and trade your plan.